For decades, the global economy has been expanding on a foundation most people never question: credit. Not money created from work or production, but money created from borrowing. Borrowing by governments, companies, banks, and ordinary individuals. This borrowed money has fueled growth, powered markets, created bubbles, and funded lifestyles that never truly belonged to us. But behind this apparent prosperity, an enormous problem has been quietly growing. A problem economists warned about, central bankers ignored, and politicians made worse. Today, this problem has transformed into something far larger than a recession. It has become a credit bubble so massive, it threatens to wipe out nearly 40 years of global wealth in a way few people are prepared for. This is the story of how the credit bubble formed, how it spread, why it became uncontrollable, and what happens when it finally bursts. The modern credit system began with a simple idea: borrowing money today in exchange for repayment tomorrow. It sounds harmless. For centuries, it was. Credit was limited. Lending was conservative. Debt was used mainly for wars, emergencies, or large-scale national projects. But after the 1980s, something changed. Interest rates fell dramatically, making borrowing cheaper. Banks became more aggressive. Financial innovations, once designed to protect the system, were twisted into tools that multiplied risk. And governments, addicted to growth at any cost, encouraged more borrowing. Households borrowed more to buy homes. Companies borrowed more to expand operations. Investors borrowed more to speculate. And governments borrowed more to keep voters happy. Slowly, borrowing replaced productivity. Debt became the engine of growth. And the world grew comfortable, living beyond its means. At first, it felt like magic: faster growth, rising stock markets, booming real estate, companies expanding, people buying homes they couldn't afford, governments promising benefits they couldn't fund. Everyone thought the good times would last forever. But all we were really doing was stealing from the future. Central banks, especially the Federal Reserve, became the main architects of this bubble. Every time the economy showed signs of weakness, they cut interest rates. Every time markets fell, they created new money to push them back up. This created a dangerous illusion that the economy could grow forever without consequences. With interest rates falling for decades, borrowing became so cheap that saving felt unnecessary. Why save slowly when markets were exploding? Why work harder when debt could make life easier? Corporations realized something incredible. They could borrow billions at low rates and use that money to buy back their own stock, making their share price rise without creating any real value. It was financial engineering, not financial progress. Governments realized they could run deficits without fear because central banks would always step in to print more money. Investors realized markets were being artificially supported, so prices kept climbing, sometimes doubling, tripling, or even soaring far beyond real value. Behind the scenes, debt levels exploded at every level: household debt, corporate debt, government debt, and the most dangerous of all, hidden, unregulated shadow banking debt, which grew in the dark where regulators couldn't see. The credit bubble had gone from large to unstoppable. If you want to understand how big the bubble is, look at asset prices. Real estate didn't just grow, it doubled, tripled, and in some cities, increased tenfold. Stocks didn't just rise, they reached valuations higher than any time in modern history. Bond markets didn't just expand, they ballooned to over $300 trillion, far larger than the world economy itself. People felt richer. They saw their home prices go up, their stocks go up, their crypto go up, their investment portfolios go up. But they didn't realize something critical. This wealth wasn't real. It was credit-inflated wealth, wealth born from debt, not productivity. And debt-based wealth always collapses. Every $1 of real economic growth was being matched by $3, $5, even $7 of new credit. No system can sustain that forever. Yet the world kept pushing forward, believing that money created from thin air was the same as money created through real output. It wasn't, and the bill was coming due. Economists saw the danger early. The debt-to-GDP ratio of major countries was skyrocketing. Household savings rates were collapsing. Corporate leverage was hitting record highs. Banks were holding trillions in risky loans. Real estate bubbles were forming everywhere, from North America to Europe to China. But instead of slowing down, governments accelerated borrowing. Why? Because debt makes the economy look strong. Debt keeps people spending. Debt keeps stock markets rising. And rising markets keep voters happy. Every warning was ignored. Every sign was dismissed. Every economist warning about a credit bubble was labeled to negative. Meanwhile, the world grew more fragile. When COVID hit, the bubble exploded even faster. Governments printed more money in 2 years than they had in decades. This flood triggered inflation worldwide. It exposed how weak the global financial system really was. But instead of reducing risk, central banks made another mistake. They raised interest rates at the fastest pace in 40 years, crushing borrowers, destabilizing banks, and pushing heavily indebted nations to the edge. The bubble was now under maximum pressure. Credit bubbles don't collapse slowly, they crack gradually, and then explode suddenly. The breaking point comes when borrowers can no longer repay, when governments face unsustainable interest costs, when banks hide too many bad loans, when companies default because debt becomes too expensive, when consumers stop spending because their credit cards are maxed out. All these signs are appearing now. Small banks have begun to fail. Commercial real estate is collapsing. Governments are spending more on interest than on healthcare or education. Consumers are drowning in credit card debt. Corporations holding trillions in low-interest loans are now forced to refinance at triple the cost. Once defaults begin, they cascade. One company fails, one bank collapses, one market panics, then it spreads globally. Because the world is more interconnected than ever before, and when credit tightens in one country, it affects all countries. This is the domino effect economists fear, and it's already starting. Most of the wealth created over the past for decades is not real wealth. It is asset price inflation fueled by debt. Homes inflated by easy mortgages, stocks inflated by cheap corporate borrowing, bonds inflated by central bank manipulation, governments funded by deficits instead of real income, companies valued not by profits, but by borrowed growth. When the credit bubble bursts, asset prices fall back to their real value, and sometimes below it. This means housing markets can lose 3,060. Stock markets can lose 40 to 70%. Bond markets can face trillion-dollar losses. Currency values can swing violently. Retirement funds can be wiped out. Savings can collapse through inflation. Governments can default. Banks can fail. This isn't fear-mongering. This is the natural ending of a debt-driven economy. And because the bubble has been growing for 40 years, the collapse will erase 40 years of artificial growth. When credit bubbles burst, the world always resets. Currencies change. Financial systems rebuild. Debt gets wiped out. Governments restructure. New rules replace the old ones. The question is not if there will be a reset. The question is what type of reset it will be. Some economists believe it will be inflationary, where currencies lose value to erase debt. Others believe it will be deflationary, where asset prices crash and credit evaporates. Some believe there will be digital currencies replacing old systems. Some believe major governments will restructure their massive debts. Some believe a new global financial order may emerge. One thing is certain, the world after the credit bubble will not look like the world before it. The financial system we've lived under for decades is ending, and a new system is coming, whether we like it or not. Most people think economic crises affect only markets or governments. They don't realize these crises reshape everyday life. A bursting credit bubble means jobs become unstable, loans become harder to get, prices rise or fall unpredictably, savings lose value, retirements shrink, opportunities disappear for years, and new opportunities only rise for those prepared. What is happening now is not a normal recession. It is the unwinding of a global credit experiment that lasted 40 years. And like every major financial cycle in history, it ends in one way, with a reckoning. The credit bubble is not just a financial issue. It is a reflection of how the world has lived far beyond its means, How governments postponed responsibility. How corporations preferred debt over innovation. How consumers chose lifestyle over savings. How central banks encouraged decades of artificial growth. For 40 years, the world borrowed from the future. Now, the future is demanding payment. When the bubble bursts, whether slowly or suddenly, everything, inflated by decades of cheap credit, will deflate. Markets, real estate, currencies, governments, even entire economies. This is not the end of the world, but it is the end of an era built on borrowed time, borrowed money, and borrowed prosperity. The credit bubble that built 40 years of wealth is about to become the force that destroys it. And when the dust settles, a new financial system will rise, one shaped not by unlimited borrowing, but by hard lessons learned from a crisis generations will never forget.